up to 2.8.
Okay, Sajid. Yeah, sure. Go ahead.
No, nevertheless, we have seen a fairly bad trade number, imports and exports falling. As well, we've got a terrible IIP number, which was a contraction of 2%. What would you guess, Madan? Can this unleash some kind of, so much of resistance to producer prices getting raised that the Reserve Bank is mollified by these IIP numbers? What's your guess for Jan 28?
So for Jan 28, I would tend to believe that the Reserve Bank of India would follow a status quo position. In terms of what's happening in the real sector, if you look at the IIP, I think the numbers have been quite abysmal for quite some time. And I think, in fact, having a negative growth for these many months actually shows that there's some kind of an industrial recession. But I think the focus has tended to be more on inflation so far and more a kind of a reaction to inflation rather than something which can preempt inflation. And given the fact that the inflation numbers, at least the headline inflation numbers, seem to be moving downwards, that would be taken as a positive sign by the Reserve Bank of India for future action, probably in the month of March, but definitely not in January.
Okay. Sajid, how much of this is an aberration, the month of December and the CPI and WPI readings for the month of December? What is the trajectory that we could possibly expect in the next 2 months? Would we see an uptick on a month-on-month basis?
Again, it comes down to how food prices evolve. That's been the main sort of source of volatility in the last 2-3 months. You've actually seen January food prices correct even further in the first 10-12 days of January. That should mean that, especially in the CPI, you should see some moderation in headline inflation. So I think, yes, December headline was an aberration given what happened to vegetable prices. The RBI was correct in recognizing that. And so the headline rates, I think, should soften a little bit in the coming months. I would expect WPI to go up again in March because you've got a favorable base effect the next 2 months and then the base normalizes in March. But again, I think if you think about where monetary policy action has to be, I think in 2014 it will be guided more by the evolution of core inflation and pricing power and less by month-to-month fluctuations in headline, given that these are temporary price shocks most of the time.
Okay, well, I guess we have to also look a little bit at the stock markets, especially at the Bankex. With the yields falling now to 8.62, that's a big fall that we are seeing in the bond yields. You're seeing a sharp uptick in Bank Nifty. No, that's not what I'm looking at. We must pull the intraday of the Bank Nifty, and that will give you an idea of how big the change has been. Bank Nifty sees a seminal jump up with the bonds on the books of banks now looking much richer than they did 24 hours ago, or in fact 48 hours ago. That's the Bank Nifty. As you can see, a big spike up coming after the bond yields fell so sharply when the WPI numbers came in. So clearly the market's now factoring in that there shouldn't be a rate hike on Jan 28. Manoj, what will be the band in which you will see the 10-year move now? Are there more gains to be made? Do we get to 8.5?
I think it will depend now largely on the the tenor of RBI's statement on the 28th. I think more or less, given that they will not do a hike. So I would think that you will see the pre-WPI number as being a cap for the time being on the 10-year yield. Just Lata, just to bring you to one, bring to notice one point, that from an RBI perspective, being hawkish and keeping rates at an elevated level seem to be achieving a kind of desired effect, if you notice. For one, the inflation numbers on the food side particularly have come off sharply, and one of the reasons they had kept rates higher was because of that, And the second one, of course, if you look at the IIP numbers, the biggest damage has been seen on the consumer durable side. Now, consumer durables 21% down from November are dependent a lot on financing, on bank financing. And the fact that rates are elevated means that financing would have played an important part in terms of the deceleration there. So I think RBI needs to focus on these numbers, and if they do, then they need to take heart from the fact that the hawkishness has helped out and possibly run its course, and they need to start looking at how to ease out conditions so that we have more focus on the growth part rather than the inflation dynamic.
Sajid, how would you read core inflation or core WPI inflation? Because that's remained stagnant at or maybe marginal uptick on a month-on-month basis. And this comes at a time when growth is completely in the doldrums. We had the IIP figure, which was completely contrary to what we are seeing in the core WPI figure. So why exactly are we seeing this uptick coming into the core WPI figure? And how is the trajectory going to pan out according to you?
That's exactly the right question to ask, I think, because I think we can quibble about what will happen in the Jan review or the March review, but there's a more fundamental point here. If you're of the belief that there are large negative output gaps in India, we should not be seeing these core numbers, whether on the WPI side or the CPI side. We should have seen core prices completely collapse, given how weak growth momentum is. So the fact that CPI, core goes up 0.6% month on month, these are largely non-tradables. The fact that tradable good manufacturing inflation is still rising at 0.3, 0.4 month after month tells me that output gaps, despite weak growth, are not as negative, which unfortunately leads to the conclusion that potential growth in India is not as large as we would like it to be. And the reason that's important is it's possible the RBI will be on hold this quarter because growth momentum is expected to weaken further given the fiscal compression that's expected, the expenditure compression in Jan, Feb, March. But if you believe growth's going to pick up in the second half of the year, then given where output gaps are perceived to be right now, that most likely will mean that inflation pressures will also rise in the second half of the year. And that tells me that monetary policy will have to be tight throughout 2014. I don't subscribe to the view that in 3 or 6 months' time, there will be the time and the space for the RBI to start easing policy and cutting rates.
Okay, but the market is at the moment of a slightly contrary view, I would think, Sajid. Clearly the manner in which the Bank Nifty has run up, and in fact even the market 6315 was touched, it was the highest point of the day, and that actually brings us within shouting distance of even 6360, which is the all-time closing high of the markets. So the market's clearly charged. Let me just expand this discussion and get Madan in. Madan, does the door open for a rate cut? There is the other view represented by Sajid. Does the door open for a rate cut anytime now?
No, I think there's definitely a door open for a rate cut, but that will be in the month of March. And I think it will be more symbolic in nature of having a 25 basis cut in interest rates in case both the CPI and the WPI inflation numbers come within certain bands which the RBI has in mind. Now when I'm talking of bands, I'm referring to something like 9 to 10% CPI. If WPI is between say 6.5 to 7%, I think it will be a good enough signals for the RBI to lower the interest rates.
Okay.
So therefore I think in March we could be expecting a 25 basis points cut in interest rates, and probably going ahead in 2014-15, if similar conditions do prevail, we could probably have another 50 basis points cut in the next financial year.
Well, I'm personally still somewhere closer to where Sajid is. I wouldn't expect a rate cut with core inflation at 8%. But Manoj, your view? Is there a scope for rate cut? Will the markets have to factor that in at all?
I think, Lata, my view has always been that India will remain a high inflation economy. So in case rate cuts do happen, they are not totally in sync with the inflationary scenario. They happen because somewhere the regulators take a call that growth is now becoming far more important than the inflationary dynamic. So for me, I don't think really rate cuts are around the corner at all. If at all there is a rate cut, maybe in March or even later, it will be largely more symbolic than actually to be very huge.